I'm joined in the studio now by Paul Donovan. He's Managing Director and Chief Economist at UBS here in London. Thanks very much for being with us.
No problem.
Happy New Year.
Happy New Year.
So does this ADP report make you more optimistic about the US economy?
ADP on its own, no. ADP is dubious reliability when it comes to predicting month-by-month moves in the labour market. But when we take ADP along with the ISM surveys of business confidence, along with the National Federation of Independent Businesses survey of small businesses, you've got a picture of an economy that is doing okay, doing reasonably well. Now, it's not powering ahead. I'm not talking about, massively above trend growth or anything like that. But we've got a picture where jobs are being created. We're maintaining the status quo quite comfortably.
Now, we had the Fed minutes out earlier on this week, and it was still justifying QE2, saying that it is working. Do you believe that it's working?
I think that it is working. I don't think that we have liquidity risk premia rising in the banking sector, and that primarily is the aim of the Fed's quantitative policy measures. Now, of course, bond yields have risen, and you say, well, the Fed's buying bonds and bond yields have gone up, so surely this is a bad sign. But the Fed is using bond yields merely as a tool. It's not the policy objective to keep bond yields down. The policy objective is to get people taking risk again. And if bond yields are going up, that could be taken as a signal that people are taking risk. It could actually be a signal that the quantitative policy is working. And I think overall, when we look at the overall economic position, we can see a situation, no liquidity risk premium, some increase in risk appetite. I think the Fed's pretty happy with what they've achieved.
Do you think that the Fed is too concerned with the labour market and that part of its mandate?
I don't think so, no. We've got a situation now where even accepting the fact that probably the trend rate of unemployment is now higher, the natural rate of unemployment is probably closer to 7% than 6%. Even accepting that, you've still got a lot of spare capacity in the labour force. Now, that's very damaging to an economy in the long term, and of course it's very damaging in a political sense. So I think the Fed is right to be focused on reducing that spare capacity if it can.
Let's switch gears to Europe. You have George Osborne in the Financial Times writing today saying that Europe must get its house in order, must get its banks in order, and soon.
Yeah.
With regards to another round of stress tests, how useful would that be for Europe?
About as useful as the last round of stress tests, which showed that the Irish banks were entirely solvent and there was no problem at all whatsoever there. It showed that the German banks had no problems whatsoever. I mean, really, nobody believed the last lot, so why would you believe the next lot? Unless they are really credible. But if they're really credible, then you run the risk that investors panic as a result. I don't think that stress tests are necessarily going to help. What we want is concrete action from European governments to tackle the problems that everybody knows exist.
How about the banks? Do you think that they need to go beyond topping up capital and into restructuring?
I think it's very much a case-by-case basis. At the moment, we've got the ECB providing a great deal of liquidity to the financial system, which is allowing time for banks to rebuild capital without necessarily going through a disruptive restructuring process. They can restructure under the auspices of ECB liquidity and with government assistance at home, but they don't have to necessarily restructure in a disruptive manner. The question is how long the ECB can continue to provide this degree of liquidity. I mean, 70% of GDP was being provided to Irish banks before the bailout. This is not a good situation to be in. Given
this assessment of the US and the European economies, in terms of asset allocation, where are investors best placed this year?
Well, it's probably still the United States, but we shouldn't write off Europe. Now, the European economy is, I think, on a recovery path. The core European economies are doing fine. The periphery, different case. But what we've got, of course, are large companies in Europe that are doing a lot better than small companies, and large companies that are exporting, who are benefiting from the global economic pickup, and they're in a relatively good position. But still, on balance, I think the US is probably better positioned than Europe in terms of equities.
Right. Paul Donovan, UBS, thank you so much for joining us.
Thank you.